Hey dear friends, Happy New Year is in order. We have survived the old year, 2019 is here, looking forward to great things or the continuation of great things. We had started on a journey in 2018 and it's our intention to get to even greater and better things this year. So this is the season, huh? This is what we call the tax season. A season that is characterized by quite a bit of frenzy on both sides, tax preparers and taxpayers alike. Just before I go into today's presentation, I would like to issue just a simple word of admonition. I appeal to all my friends, my clients. Do not be misled. Do not be misled by what I refer to as spurious claims and promises of mini fortune tax returns, tax refunds. Okay? Do not allow yourself to make less than wise decisions as far as your tax returns are prepared. Do not allow yourself to be exposed to what could be months and sometimes years of grief as you wade through the quagmire of IRS audits. These audits can be quite lengthy, intrusive, crippling, and at times even nightmarish, as language such as wage garnishment, bank levy, and property lien starts floating around. So I implore you, live above the hype, live above the spurious promises. To my fellow tax preparers, let honesty and integrity be your standard. To my taxpayers, let wisdom and temperance be your motto. And here's a word of caution. There is absolutely nothing that you can contrive that the IRS has not seen and dealt with before. I repeat, there's nothing, absolutely nothing that you can contrive that the IRS has not seen or dealt with before. Simple word to the wise. Good. Now today I want to look at individual retirement account. Individual retirement account. And the approach that we're taking here is to look at the great tax benefit that can come from such an account even after the tax year in question has ended. So let us look at what I refer to as a traditional individual retirement account. Now, individual retirement accounts are funded by what is referred to as pre-tax money. And so you're able to open such an account, fund the account by making your contributions, and then turn around and get a tax deduction, a tax write-off for the contributions made to this account. and that's a traditional IRA using pre-tax money. Now, if you are allowed to make a contribution of up to $5,500 to such an account, and if you're 50 or older, you're permitted to contribute $6,500. So then, what is the uniqueness about such an account? The uniqueness about this account, as far as tax benefits go, is the uniqueness is there are many peculiarities about this account that makes it so attractive. First thing, although you did not have this account in 2018, you're allowed to establish and fund this account anytime up to the end of the normal tax filing season, which usually would be April 15th, 2019, and still be able to take the tax write-off for this contribution, this investing of funds into the IRA account. And so what it means is you can open such an account anytime from now until April 15th. Fund this account up to the tune of 5,500 or 6,500 and be able to take it as a deduction against your 2018 taxes, although you established such an account in 2019. Very, very important to know. Be very careful. When you go to open such an account, you need to indicate clearly that your contributions, you want your contributions to be applied to your 2018 tax year. You're opening the account in 2019, but you want to ensure that your contribution, your funding of this account is applied to 2018. Mark you, if you're contributing more than $5,500 or $6,500, then of course you want to specify that the first 55 or the first 6,500 is applied to 2018, and I suppose the excess can always be a 2019 contribution. So that is very, 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 very important that you do that. And remember also that the stipulation is that this account must be established and funded up to or by the normal tax filing season, which is April 15, 2019. Once you establish and fund such an account, then you're able to take up to the full $5,500 or $6,500 as a deduction on your tax returns. Now, as usual, everything has its rules and stipulations, but basically, we're saying if you're single and you have an income that is $62,000 or less, then you'd be able to take the full $5,500 or $6,500 deduction. If you are a married couple and your income of $99,000 or less, then of course you can go full deductions. Income levels above these numbers will cause the extent of the deduction to be reduced. As your income go up, then you're allowed less and less deduction for tax purposes. But best case scenario, we're saying that you can contribute and be able to deduct for tax purpose the full $5,500 or $6,500. So obviously, right away, the income level, your income is one determinant as to whether or not you can take full deduction. The second thing to think about is whether or not you are already covered under what is referred to as an employer-sponsored retirement account, like a 401k. So if you are benefit under an employer-sponsored fund, then or account, then it means that the extent of your deductions from that IRA contribution could be limited because you're already getting some benefit on the 401k side. Now, remember what we pointed out, that the funding of your traditional IRA is done using pre-tax money, okay? Pre-tax money. and that is why you're able to take that deduction on your tax returns. I re-emphasize this because we want to contrast the traditional IRA with what is referred to as a Roth IRA, ROTH IRA. And this IRA is one that is funded from or with after-tax dollars. After-tax dollars. As a result, there's no opportunity to, you do not have the opportunity to make a tax deduction if you actually have what is referred to as a Roth IRA. So first thing, remember, you want to open a traditional IRA. You want to indicate clearly that you want your contributions to be applicable to tax year 2018. And by so doing, you're setting up yourself to be able to have what you call an individual retirement account tax deduction, so to speak, on your tax returns when you prepare 2018 returns in 2019. Okay? Now, this IRA account, in my view, is a win, 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 win account. And it's not by accident that I said win 4 times, because I can see 4 instances of winnings by going this route. Say, for example, you, without such an account, you would have had possibly a tax debt of say $800, $1,000, etc. Then with this account established and with you getting the write-off, it is possible for you to totally erase or reverse the fact that you would have had a tax debt. That's win number one. Win number two, it's possible that this credit, this deduction is such that it totally erases the potential tax liability and still generate for you a refund. So it eliminates the tax debt. It can also go further to generate a refund. That's win number two. Win number three, you have now taken dollars that you would normally pay out as taxes and have invested it into your own retirement account, which will benefit you down the road. And while it works, it is earning naturally. As the years roll by, such an account is earning you additional income. So that is win three. That is win three. Win four. Because the traditional IRA is funded from pre-tax money, it means that down the road when you're retired and you're ready to take your funds, then those funds, those distributions will now be taxable because they were not taxed upfront. And so they now become taxable. And so the question that may pop to mind is that, okay, so what's the benefit in that? Because, I, as it were, avoided the tax earlier on, a couple years back, but now I have to contend with it. And I'm saying, hold up. In the years prior, when you made this contribution, you were employed, you were earning income, from your job, etc. And therefore, your total income would have been such that you were put in a particular tax bracket because of your income level. You could have been in the 25, 20, 25, 30% tax bracket. So had you had those dollars taxed then, they would have been taxed at those effective rates. Having gone this route of the IRA and postpone the taxation, now that you're pulling your money at retirement, you no longer have a job, you're no longer earning these large sums of money. And so instead of being in a 25, 30% tax bracket, possibly you're now in a 10 to 15% tax bracket. What does that mean? It means now that you're pulling the IRA funds with the income that is earned on the fund, although it is taxed, it is now not taxed at a 25, 30% rate, but it is now taxed at your current rate, your current effective rate, which would be the 10 or 15%, because that is now that is where you sit because you are no longer earning these large sums. So for me, that is win number four. Win number one, you erase a potential tax liability. Win number two, you may even go further to generate for yourself a refund. Win number three, you have used money that you would normally pay out as tax to create your own retirement account for your benefit down the road. And win number four, even though you will have to pay taxes on those monies at the time of distribution 10, 15 years down the road, the fact is 80% chance, 85% chance that because your financial situations will have changed, then you'll be in a lower tax bracket. And as a result, those funds, though taxed, will be taxed at a much more favorable rate than if they were taxed upfront when that initial account was established. Okay, very important. Now, I almost think that there is a win, I said four, win five, because you are also entitled to what is referred to as a retirement savings contribution credit. The mere fact that you decide to invest money, put money into a retirement account, cause you to qualify for what is referred to as a retirement savings contribution credit. And this can go up to a maximum of $2,400. Of course, you may be able to attract the maximum deduction or credit, or you may go somewhere below. But the fact is, that's another benefit. So right away, we're seeing five outstanding credits coming from this IRA, traditional IRA account. And the beauty about it is that you're getting all these benefits, although you had not established that account from the prior year, which would be the tax year of 2018. You're doing it in 2019, but still able to benefit significantly by this action. And so that is very, very, very important. Now, let me contrast two things. The traditional IRA is one where you're allowed to establish and fund the account up to the normal expiration of the tax filing season. There's also what we call a SEP IRA, which is the IRA that is normally used by self-employed, business persons. Okay, same principle, you're able to deduct the contribution, but there are some key things about the SEP IRA. Number one is that you are allowed to contribute 25% of salary into such a SEP IRA. 25% of salary up to a maximum of about $54,000. Okay, up to a maximum of 54,000, you can do that and get the same benefits, the same, be able to deduct. But it goes further than that. Whereas with the traditional IRA, you have to fund this up to the normal tax filing period that ends April 15. With the SEP IRA, if you were to apply for an extension to file your taxes, which takes you beyond April 15, but up to say September, or some September, even maybe October of that year of 2019, then we're saying you are allowed to be funding this account up to that September-October period and still qualify to get that deduction in 2019 for against 2018 taxes. So let us say that your circumstances allow you to fund the account up to the maximum $54,000, but you're unable to come up with a lump sum $54,000. The point is you really have 9 months over which you can spread your contribution. So you open the account and you keep contributing. If you can do $5,000 each month, it means that in 9 months you'd have had $45,000 in there. And so you can now go to your $45,000 deduction or up to your 25% of your salary, but of course the cap is at 54,000. So that again is an additional benefit, but that applies to the SEP IRA, which is what most self-employed business persons would use. So a lot of beautiful advantages to going the IRA route. Now, the intention is that once you establish this account, then we know that you plan to keep the account until retirement. That's the intention. So at retirement, or once you are 59 and a half and above, you can now take your funds, pay your taxes, And you can do that without suffering from what we refer to as an early withdrawal penalty. Because anywhere below, when you're less than 59 and a half years of of age, then any withdrawal is considered early withdrawal and it attracts a 10% penalty. Anytime after 59, 59 and a half up, you're able to do that without. Now, if you find that it is necessary for you to withdraw funds from your IRA prior to 59 and a half, and the penalty comes about, then there are three cases or three scenarios under which you may be able to get a waiver of this penalty. One, if the funds are used for first-time home purchase. Two, if the funds are used for higher education for yourself, your spouse, your dependents. And three, if the funds are utilized for medical expenses in excess of 7.5% of your adjusted gross income. So those are some of the conditions under which you can have an early withdrawal of your fund from the IRA account and still be able to avoid that 10% penalty. However, the tax will have to be paid. But as I said before, the tax will be paid at your current effective tax rate, which more than likely is going to be significantly less than what it was back in the earlier years when you were working, earning a salary, and was sitting in what I would call, a much higher tax bracket. Okay, so that said, I want you to just, think about this think a little more about it and consider it to be a very attractive vehicle that can both reduce your tax liability and at the same time establish for you a fund, a pool that is going to benefit you down the road. Okay, so that's about it for individual retirement account. And remember, let it be the traditional, not the Roth. Okay, the Roth is not deductible, the traditional is deductible. So I encourage you to explore this. And I also encourage you to subscribe to our channel, Etienne's Place, so that you can access all the prior video that we have done and all the videos to come. Because we really have what I consider some great stuff and very informative stuff that we want to send your way. Because the intention here is to have everyone, 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 sophisticated or otherwise, be able to understand the simple principles, the simple rules and regulations that govern, business practices, business execution of business activities, and so empower you to make the right decisions, sound decisions, and be able to evaluate and move your business in a very positive direction. So thank you again for joining us at Etienne's Place. And remember, as usual, we entertain no problems here. Challenges, yes, we face. That's the order of life. But this is where we find the solutions for these challenges. This is where we unearth the answers to the questions and put you on a path of financial stability. Thank you again. Have a good day, and we look forward to more what I call nugget as we offer week after week all the tools that we need to be successful. Thank you and bye.